Good morning from the Asia Pacific. It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm David Ingles.
And I'm Avril Hong in Singapore. We're counting down to the open of markets in the Greater China region. Our top stories. Asian stocks under pressure with a report that OpenAI is falling short of its own user and sales targets, fueling fresh tech worries. The company hitting back, saying it's firing on all cylinders. A rift in the Gulf as the UAE quits OPEC, dealing a blow to the oil cartel in the middle of the worst supply disruption in years. Also, BYD profit tumbles and short-term borrowing jumps to a record, with the years-long price war in China's EV sector taking its toll. And we speak with the CEO of RemeGen, the Chinese healthcare sector's best-performing stock, as it reports a second straight quarter in the black.
Right, welcome back. And I say welcome back because if you are familiar with the show, as is customary, really as we start the show off, over the last few days, breaking news literally as we begin the show. Out of the Journal today on Iran, Trump has told his aides to prepare for an extended blockade of Iran. Just based on that headline, I would imagine that is specifically aimed at the Strait of Hormuz. We'll get you more details, of course, once we have more information as far as that specific story is concerned. But yes, we are tracking that very closely, given, of course, where we are, this just modest but very consistent, Avril, glide higher in oil prices. And last, we closed above 110. We are still trading above 110. We've yet to actually see a down day on Brent prices over the last week and a half or so. And as you can see there, we're up 16% if you trace it all the way back to the 21st of the month. Now, all that is to say, all's well, while that continues to brew, the equity market seems to be moving along quite well. And if there was a disturbance in the force of equity markets, this was really in the form of tech and that OpenAI story. And we are moving into the thick of big earnings, of course, as far as Mag 7 is concerned, Avril.
Yeah, disturbance in the force as we move into the month of May as well. It's been a good month of April. We also have that energy shock read-through when it comes to China earnings, so that's worth highlighting as well. When it comes to the likes of Sinopec, for example, we saw how first quarter profits rose. So you really get the sense of how some of these companies are benefiting from what's happening in Iran. But against that backdrop, we also got the likes of BYD, right? Fourth quarters of profit declining. Maybe there's a turning point, and yet there has also been a bit of a read-through from the 2 billion yuan in foreign exchange losses. When it comes to the likes of Longyi, the solar giant, we are actually seeing that surge in exports after the war broke out. So another way that this has all been playing out in China earnings, we did see their first quarter losses widening, though it's really still about overcapacity. So you're about 60% of the way through in the MSCI China. And, that's playing out as well in terms of how the Iran war is affecting some of these companies, Dave.
It really is. In fact, top of the next hour, Winnie out of BofA will be joining us. I'm just looking at her report right now, and it's very, very clear. The question at the very top of that report, why has China underperformed? And it really comes down to a basic concept. It's earnings, right? And the brighter earnings story simply in other markets when you look at revisions from the start of this year. So that's something, of course, we'll be unpacking with Winnie Wu. Of course, BYD, HSBC joins us as well at the next hour as well, bottom of the next hour, to talk us through these BYD earnings. And I think, April, you touched on this, that 2 billion FX hits. When you look at what's happening on the cash flow situation, that massive bumping up of short-term borrowing. But yes, all this is indicative really of this fierce competition taking place in that market. Now, how should investors be thinking about that, this earnings report? Just to also mention it, so we talked about oil. In the next 25 minutes or so, we have Aussie inflation coming through. So just pay attention to that. The last reading was in the low threes. Expectations are for the high fours. And 4.8%, I believe, is the median estimate. That takes you all the way back about 2.5 years, and as far as that is concerned. So yes, lots of things to track, including, by the way, the tech story. And I think Taiwan is coming online right now. Can we show that, please, if we can? And the reason that's important is two things. One is we are expecting to see there the declines we were seeing in the tech space overnight, and just because of the gains we've seen in recent weeks, Taiwan has actually now surpassed Canada in terms of the size of the equity market. Can we show that, please, if we can? Thank you so much. Do we have that? There we go. Thank you so much. 0.9% to the downside. 谢谢. Okay. All right. Let's get more context as far as these markets go. David Savage is with us here, our MLive strategist. Very nice to see you. Where do we start? Tech, OpenAI, Hormuz?
Let's start tech, maybe.
Go ahead.
It was interesting because I think, as you said, given the lead-in we had overnight from U.S. tech stocks and the headlines on OpenAI, I think we were expecting a pretty significant move in South Korea open, just given the concentration in tech there. And frankly, the open's been fairly resilient thus far. And I think that points, but it doesn't take away from the fact that the more concentrated this rally becomes in a single theme, the more vulnerable it is to a much narrower set of risk factors. And I think this OpenAI demonstrated that in the U.S., and we'll see how Asia trades today. Japanese markets closed, but certainly we'll be looking at the very tech-heavy benchmarks, Taiwan and South Korea.
I mean, if SoftBank was trading, to your point, that would really be a big decline. I think futures are even down on the Nikkei today, despite the cash markets being shut. I mean, just more on the earnings story, because we're moving into big tech earnings in the U.S. Could earnings be the saving grace here?
I think expectations are very high. And I think just focusing specifically here in Asia, I think the guidance is going to be very, very important. And I think investors are going to be parsing very closely over what is said in those earnings calls. Because, again, index concentration in and of itself does not imply that these stocks, the SK Hynix, Samsung of the world, are overvalued. But it does mean that the index itself is really exposed to a very narrow set of factors. And in fact, if you look at those stocks on a forward multiple, they're trading only 4-6 times forward earnings.
It's ridiculous, actually.
Yeah, but again, those earnings have to come through, and that's going to be based on the guidance. So that'll definitely be in focus.
David, so that's the worries around AI and on stocks, but what about other asset classes? I mean, we still have the Fed this week. Do you think things are appropriately priced, so to speak?
Yeah, I think that's exactly it. I mean, if you look outside of tech, the conflict and where energy prices have been trending is certainly being more reflected there. And if you look at bond yields in the region and in the U.S., they're still very much tethered to the outcome of the conflict because they're tethered to the outcome of where commodity prices and energy prices trend. So we'll continue to have headline risk there, and that'll continue to feed through in bond yields and continue to feed through in sectors that aren't exposed to this AI theme. So I think when we look at consumer names, that's one name where one part of the market that I think is continuing to be vulnerable if we start to see this stagflationary impulse really show up in the data and then really start to drive where policymakers have to go in terms of rates.
David, fantastic. Thank you. David Savage there, out of our MLive team, our MLive strategist, on the equity markets and the complexity going into the session today. Right. The other big story, of course, is we mentioned that headline coming through out of the Journal on President Trump telling his aides to perhaps be prepared for an extension of that blockade. The sort of subplot that's emerged is this UAE exit. Of course, I think Dubai actually has a sort of greater hook to it. But yes, UAE's decision to leave OPEC is the main story there, as the global oil industry grapples with supply disruption caused by the war in Iran. Our team at Bloomberg Economics have chimed in on this. Very interesting take here that when you look beneath the hood, the clash between the two has actually been brewing. Not just this wasn't something that started just weeks ago. This was months and years in the making, and the Iran war has simply widened that fracture. Flip the page, please, and have a look at where we go. And as far as oil markets go, and perhaps the potential impact on the oil markets and the take from Ziad and his team there is unlikely to react as far as oil goes. The issue isn't how much Gulf producers actually want to supply, is whether they can actually supply what they want to supply. And I think it's something we'll get into right now, Avril.
Yeah, with our colleague Steven Stepczynski, who leads our Asia energy coverage, and he joins me in the studio. So, Steven, I mean, we're getting these headlines, right, about how maybe this blockade will be extended even further. So maybe what we're seeing in Brent kind of makes sense because we're at levels we saw before the ceasefire began. Mm-hmm. But the UAE thing, longer term, what is that going to mean for the market balance as well?
I think that's more of a, obviously not any near-term effect because they can't get the oil out, but more long-term, the importance of OPEC is in greater question. There have been other OPEC members that have left over the years. Smaller oil producer Qatar left a few years back, Angola. But the UAE is a pretty big blow. They're the third largest producer in OPEC, and they have, they're one of a few producers, basically just Saudi and them, that have the ability to spare capacity to potentially maybe increase their output, according to the IEA. Now, some analysts say that the UAE is already pumping at maximum capacity already, but the fact of the matter is, if they're losing these members, what importance does OPEC and OPEC Plus have on the wider market? How much ability do they have to actually sort of balance the market? And are there questions about other members leaving? We had a Bloomberg report just in the last 12 hours, kind of surveying a number of different officials within the OPEC group. So far, it doesn't look like we're going to see a mass exodus from OPEC Plus, but I think it does, sort of change the way that you look at the organization and how Saudi Arabia will effectively have influence in the market going forward.
Yeah, talk to us also about this rift that has been brewing for a while between the UAE and the Saudis in terms of the difference in visions or ambition.
It kind of goes back. It goes back to COVID in one way, but I would even say it goes back before then. But let's look at COVID for a minute. So in 2020, obviously oil demand fell. We had famously oil prices in the U.S. going negative. Inventories were brimming. And one of the decisions by OPEC and the wider OPEC Plus organization was to cut back production. And that was led by Saudi Arabia. According to our reporting, the UAE and ADNOC, the main state-owned supplier out of the UAE, had wanted to actually increase, at least keep their production steady to continue to hold market share. But by doing so, by reducing their output, when oil prices rose again inevitably in 2021, you saw shale producers take more and more of the market, as well as other producers around the world. So this began the rift. I mean, there are other things beyond energy that are happening as well between the two countries. I think one thing that is quite fascinating, especially in this recent conflict with Iran, is that the UAE and officials from ADNOC have been very outspoken about Hormuz and about the situation. And while Aramco as well has talked about it, it just seems that the UAE is much more out there, kind of putting pressure on ending this. Whereas Saudi Arabia, you haven't seen quite as many public comments coming out. That's one approach there as well. And then lastly, I think you also look at the economic power that both of the countries are trying to hold. The UAE has Dubai, a large economic hub for talent. Saudi Arabia is competing to do that as well and trying to create a similar sort of situation in Riyadh. Is that part of that tension within the region as well? Right. Something interesting to look at.
Okay, so some of these longer term shifts, but short term we're moving by the headline, and we are getting word that maybe they're going to extend this blockade on the US side.
Yeah.
What do we know perhaps also on the Iran side in terms of shut-ins, and ultimately what is that going to mean for prices?
Yeah, I mean, I think it's a really interesting headline that we just got from the Wall Street Journal. I think if you can't look at Iran without looking at what the U.S. is doing. So if the U.S. does extend this for weeks or months or even longer, I don't have the report in front of me, but just based on that, it sounds like that's the rhetoric, then potentially you will get shut-ins from Iran. Not in the matter of days, but according to Kepler, which is an analyst that looks at ship tracking data, they're saying more like weeks. I think their latest forecast was a bit more than 20 days. So this goes on for about 3 more weeks or so. Then we're in a situation where Iran will have to adjust their production. I think one thing to note, I think Bloomberg columnist Javier Blas had said this before, but this is not Iran's first rodeo. They've had to deal with sanctions. They've had to deal with tension. And so they know how to reduce their production. They know how to grapple with the uncertainties of the market. So just because they're reducing their output doesn't mean that their facilities will immediately be damaged or that this is a long-term shut-in. They have the ability to also increase output potentially if there is an agreement and they are able to clear some of that storage. I think the bigger risk to the region is more how many ships are willing to go through Hormuz, because as this U.S. blockade continues, Iran will likely continue their blockade. And therefore, if that just creates a logjam for the region. And when you look at the daily crossings, we are nowhere near where we were at pre-war levels, which was 135 or more ships on a daily basis. So this just continues to throttle the market. It continues this shut-in of 10 million barrels per day of production within the region. And it's just going to continue to tighten the market and potentially lead to higher prices.
Okay, Stephen. Great to get you on, as always, talking us through the latest headlines as well as some of what's come out in the energy markets in the past day. And still ahead, Chinese EV giant BYD feeling the squeeze of the prolonged price war with short-term debt surging as profits slide to a 3-year low. All the details and analysis next. And we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show. So we're still on watch for earnings out of these Chinese companies. And of course, we've talked about the EV players. We've talked about the solar giant LongE. We are watching, of course, Geely, that's set to report as well. And then, of course, the big test for the China bank trade that is due with these big four that are reporting. So that's something else to contend with today. In terms of BYD's earnings, we did see how, they showed fourth quarter of profits declining, but the short-term borrowings jumping 72% last quarter to about $9.7 billion. That was something else that was a bit of a shocker as well. Quarterly profit tumbled 55% to its lowest level in more than 3 years. And all this kind of suggests that BYD's cash needs have become increasingly urgent as China's years-long price war takes its toll on the country's car makers, Dave.
It really is, right? And it's times like this where it's important to look at the cash situation, right? Cash does not lie. When you look at cash flow, for example, and I think our Bloomberg piece actually does fantastic justice to this piece, right? You have inventories picking up, bills payable picking up, short-term borrowing picking up. Not that we are anywhere close to sort of drastic territory, but I think it's very reflective of the competitive environment, the amount of caution that is reflective of the changes to the cash flow statement, right? So what you have here is classic free cash flow, net changes in cash, free cash flow is in purple, net changes in cash is white. You have the three massive components of cash flow, investing, operating, and financing. And what you do have is, of course, from an operation standpoint, that's in green. And you can see that, of course, coming in very, very low compared to the previous quarter. Where you do see a massive spike is the spike in financing activities, right? So being able to borrow cash to plug whatever working capital needs that the company may have. But that is what we're seeing in as far as this is concerned. And I think it's really indicative, Avril, when you look at free cash flow remaining negative, that's the ability for the company, of course, to fund future capex. And short-term borrowing seems to be, and we haven't heard directly from the company specifically on this, seems to be the way that the company is bridging maybe some of the cash burn that's taking place because of some of the inventories that are piling up. But yes, let's get into all of this, of course, Avril.
Yeah, with our Bloomberg Intelligence auto analyst for China, Joanna Chen. She joins us now. So, Joanna, we've just run through what's at stake for BYD in terms of borrowings. We're also seeing how their earnings decline for a fourth quarter. Maybe that's adding to expectations that things have bottomed out. Are you expecting a turnaround for the EV maker?
So BYD is definitely at a turning point. We saw a brutal year of earnings declines. First quarter was particularly bad with not only weaker volume but also the currency losses. So at this point, we are seeing some turnaround starting to shaping up. We saw overseas sales are remaining very strong, especially with the current oil shocks, and domestic sales after BYD's latest launches with the second generation Blade battery has stoked a lot of consumer interest, and we saw showroom traffic picking up pace. Well, we have to say, second quarter, there will still be some higher costs because BYD needs to ramp up the battery capacity for the new models, and also they need to clear some older inventories. But definitely, we're seeing that second half will be a much stronger recovery for BYD, both in the sales and also the bottom line.
Just in terms of the macro factors involved, this global oil shock, how are you expecting that to influence the momentum in BYD financials?
So definitely the EV sales overseas, and also BYD also has this energy storage business.
Right.
That's all. Both of them are benefiting from this global energy crisis and oil shocks. Especially in Asia, we see that Southeast Asia and also Australia, consumers are flooding into all those EV lots, and they are taking whatever available in inventory.
Okay.
So BYD, they are really trying to boost their shipping capacity to all those markets to fill in that demand.
That's a good problem to have. Joanna, thank you so much. Joanna Chen, there are China auto analyst at Bloomberg Intelligence. Later on, in about 60 minutes or so, HSBC's Yu Chen-ding joins us. Of course, she also covers autos for the bank there. BYD in the early going, 0.7% to the upside. A preview of the trading day is just ahead. This is the China Show. Okay, really uneventful approach to the open today. We're in the thick of earnings, so perhaps the stories are more idiosyncratic, like BYD, of course, coming up on your screens. As Avril was pointing out, the big banks are coming through with earnings later today, and of course, this broader cohort of other car makers are coming out. Some liquor makers are also due and making some news there. Avril, what are you watching?
Well, there's one stock. We were expecting their earnings, but it seems like that's going to be delayed. And it's delaying its earnings release for the full year as well as the first quarter by a day. So we hear, and this is against the backdrop of its chairman, of course, having been detained since late February, and softer liquor sales as well. That's what we're watching. This is Bloomberg.
Welcome back. You're watching The China Show, counting down to the open of trades. Today, as we've been mentioning, we are in the thick of earnings season. I think about 150 companies are set to report across Greater China today. Could be much, much more, of course, depending on the benchmark you look at. Apart from that, we're sandwiched between the OpenAI story that's really weighed on sentiment as far as tech goes. You had the big tech-heavy benchmarks really feeling some downside today. Japan is shut, Avril, so we really don't have that representation, although futures are pointing to the downside. But the fact that China has not been viewed really within that AI ecosystem of the U.S. perhaps would be of help today, given everything else that's happening.
Yeah, I mean, to your point about Japan, it was quite interesting, right? Following on from the BOJ and the signals that it sent, maybe there was some expectation as well that that would put further pressure on AI and tech stocks, leading to, what does that mean for the continued outperformance of the Nikkei versus the topics? But to your point on whether this helps China in a way, this AI sort of rethink that we're seeing, you're a bit lower on the mainland markets. You are still seeing the likes of Cambricon, for example, coming under pressure, which is interesting because, of course, mainland AI hardware has been a really strong play of late against the backdrop, of course, of what we're seeing in perhaps some indigestion when it comes to the consumer-related stocks. Guizhou, Maotai, Wuliangye, those are in focus. Wuliangye, of course, as we told you just a short while ago, delaying its earnings release. Now flip the board, take a look at what we're seeing in Hong Kong on a day where there is a bit of a rethink think when it comes to AI, whether the CapEx continues to pay off, translates into earnings, following on from what OpenAI missed on sales and new users. These were its own numbers that they missed, to the extent that this is, in a way, I guess, helping Hang Seng Tech 7/10 higher on that index, and we're seeing some of the consumer tech names also pulling ahead for the moment. Aside from that, take a look at BYD. Of course, we've been watching the open for this stock very, very closely, following on from its fourth quarter of a profit decline. We are also seeing those short-term borrowings surging. 2 billion yuan forex loss, but this is net what you're seeing in the market reaction. You're trading higher, about 3%. Other earnings also include the solar giant Longyi. It did show widening in the first quarter losses, but there is an expectation that, the longer this energy shock from the Iran war continues, that these solar plays will benefit. For the moment, it is still about the overcapacity in the sector that seems to be dragging the stock. Ping An Insurance, another one to watch, that seems to be a bit of an outlier and is 3% higher despite the profit falls. We're also watching, of course, today, the banks that are reporting. Dave?
Yeah, Avril, we're just getting some data coming through. I'm just parsing through just a series of data points here. But yes, it is Aussie inflation, the data set's coming through. It really just judging by the reaction in the currency markets, this seems to be more on, there is a dovish reaction across the Aussie, as you can see, was already on the way down and even seeing a further leg lower. It's an inflation miss. Not that 4.6% is not a high number. Certainly anyone who would have expected this number to come through as recently as 3 months ago would be called crazy. But 4.6%, given the reality right now, missing estimates, that we are coming off a low threes number, of course, and as far as Australia is concerned. 4.6 is the actual, 4.8 was the estimate. And as far as the Q-on-Q print is concerned, 1.4%. Perhaps the broad takeaway here, no nasty surprises. So for the RBA to perhaps react to, given the current situation. Okay, let's pivot back from the macro to the micro and have a look at these earnings coming through as well. So one of the companies that had recently reported is, by the way, one of the best performing stocks on the MSCI China Index, as you can see on your screens. RemeGen, the company just reporting first quarter results, revenue up 25% from a year back. Joining us exclusively is the company's CFO, Tong Shaojing. Good morning, and thank you for joining us. Let's talk about the results here. 25% on revenues. You have an out-licensing deal, of course, which I believe you've also received your upfront payment to. Just talk us through, do you expect the momentum to continue into the rest of this year?
Sure. Yeah, it's a strong start for our 2026, and overall we delivered another strong quarter in revenue and margin improvements. But without recapping those numbers, we achieved this revenue growth and maintained gross margin despite a 10% price cut on both of our commercialized drug starting from January 1st. And also in first quarter, for the first time in company's history, we achieved operational cash flow positive. And of course, the third, most importantly, in the first quarter, we closed the deal with AbbVie. Yeah, with all these strong elements put together, we do expect our strong growth, both domestic business and R&D pipeline, to continue strong delivery in the next 2 to 3 years.
Understood. Maybe just to zero in initially on the domestic side of the business, of course, you have that out-licensing deal which covers outside the domestic market, which we can get to in a moment. But of the two, when you look at the two drugs that are commercially being marketed right now domestically, can you give us your outlook, your projections for this year on both? For the domestic market.
Yeah, we did set a pretty clear goal for 2026 that for our commercialized products, so we aim to deliver 25+% organic growth for domestic sales. And based on that, our base business, excluding any BD revenues, we should achieve break even on P&L basis for the full year 2026. And the growth of the domestic sales are primarily driven by our two products, RC18, which is autoimmune disease drug that has been approved for 3 indications, and we expect 2 important new indications to be approved in 2026, and that should drive this drug's growth in the next several years. On RC48, the oncology drug, we expect new indications to drive growth and maintain healthy growth in the next several years as well.
And how might that growth from the domestic market help with incomes and perhaps in a way offset some of the R&D costs? What are you expecting on that front as well?
Yeah, as I just put, we aim for break even solely based on domestic business. That means our domestic sales should be able to cover all our sales cost and R&D cost. And going forward, with a larger scale of sales, we should continue to see improvement in margins in terms of gross margin, lower sales cost percentage, and our R&D will continue to grow, but not at a crazy speed. So we should expect, solely based on domestic business, we should expect very meaningful and growing profitability.
What are the priorities for R&D for your firm?
Yeah, we will keep doing what we do best. We have platforms in mono-antibody, bispecific antibody, multi-specific antibody, and also ADCs. We focus surrounding autoimmune disease and oncologies. So we will keep doing what we do best, keep generating novel, innovative molecules.
Shaojing, can I ask you about... No, please finish.
You go ahead.
Oh, I was going to ask you about the third one in the pipeline, R28. My understanding is you've entered clinical phase 3 clinical studies for that. What does the clinical data suggest? And if you could give us an indication of the indications for RC28.
Yeah, RC28 is ophthalmology drug that we already partnered with Centene. So this year, we expect toward the end of the year, we should expect approval of this so-called diabetic macular edema indication to be approved in China. And we are also filing for another indication, which is called wet AMD. That BLA is going to be filed mid this year. So we have not shared too much clinical data at this moment, but that some phase 3 data may be presented later this year. So after that, can comment on the competitiveness of that drug in this space.
Shaojing,
Yes.
at some point, will you be looking at additional financing to fund things, your pipeline, your R&D, your operations?
Yeah, we just received the $650 million AbbVie's upfront payment in early April. So with that payment, our financial situation has been fundamentally changed. We shifted from a net debt position to a heavy cash position. As I just said, we expect break even this year, and actually on cash flow basis will be positive this year, and going forward with improving margins, growing sales, we should expect our base business become cash generating business. So without big strategic projects, we do not foresee any need for additional financing at this moment.
Yeah, I mean, the beauty of how out-licensing deals are structured with that upfront payment. I guess final question for you. Should the markets expect any new or further out-licensing deals this year?
Yeah, at this moment, all our late-stage products are all partnered, licensed out. We do have new, relatively early-stage new drugs in the pipeline. And hopefully when we generating more data for those molecules, we will definitely strive to have more deals, more out-licensing deals.
Shaojing, great to have you with us. Thanks so much. Shaojing Tong is CFO of RemeGen. We'll have more in a few minutes.
Thank you for having me. My pleasure.
This is Bloomberg. Thank you.
Welcome back. You're watching The China Show. State broadcaster China Central Television says Beijing's move against the Manus Meta deal will not hurt foreign investment. Now, the commentary argues that regulation is necessary and does not contradict encouraging foreign inflows. Now, the article says that because of Manus's early R&D was conducted in China and its technical team consisted of Chinese engineers, the data and the tech behind it are linked to Chinese interests. Now, Beijing has ordered the deal between the two sides to be unwound after a months-long investigation, and the fallout from that is prompting at least one Chinese tech founder that we spoke with to put up strict walls between their U.S. and China businesses.
Yeah, to talk more about the ramifications from this move by Chinese authorities, joining us now from Singapore, Stefanie Kam is Assistant Professor of the China Program at the Nanyang Technological University's Institute of Defense and Strategic Studies. Great to have you with us, Stefanie. First off, I mean, Dave has just talked through some of the considerations, the worries. What has your read on this entire episode been?
Yeah, thanks for having me. I would frame the Manus ban as Beijing's assertion over Chinese origin strategic technological assets that have left its borders but remain linked to its Beijing's AI ecosystem. So I think this is much bigger than just Meta losing an acquisition or Beijing blocking a sale. Beijing is sending a signal essentially that frontier AI agent companies are no longer being treated as ordinary software startups. Instead, they're being recast as strategic national assets. So they're made up of assets of engineers, modern know-hows, and data, as you mentioned earlier, some of these important data and know-how by these engineers. So another key takeaway for me is also that Manus may have moved offshore, but Beijing is saying that the technology did not necessarily leave China's regulatory orbit. So the April 27 NDRC notice was brief, and that followed with the more details subsequently. But the signal from Beijing is clear that AI provenance now matters. So the point at which the origin, the technology originates. And China has ordered Meta to unwind its $2 billion plus acquisition. Despite, as we know, Singapore being Singapore headquartered, it cited national security concerns around Chinese tech talent and data routes. So this is the read that I have overall as this event has unfolded.
Right. To your point, do you think it's a bit more about potential warnings or rethinks for tech founders if they're thinking of relocating out of China more so than the actual concerns of transfer of technology, which, as you say, Manus is saying that is not something that's transpired just yet.
So I think Manus moved offshore for commercial reasons to stay visibly China-based, would make it harder to raise capital to serve global customers and to access many of these frontier AI infrastructures. And obviously, Singapore gave it the neutrality and legitimacy. But Beijing's response, on the other hand, shows the limits of this commercial logic when it comes to strategic tech and AI. Beijing's regulators care a lot less about corporate address than about the origins or the provenance of the strategic tech talent and the data. So this is where the national security concerns come in. So from Beijing's perspective, this was not just a corporate exit, but it was a potential transfer of a Chinese origin AI capability into Meta's global ecosystem. And Beijing is saying that those hands that built those models are essentially the strategic assets, and we cannot have them transferred to Meta.
Stefanie,
I think it's
David
also
here,
saying
maybe. Oh, so I was going to ask. I mean, just to build on what you just said, it's for founders and businesses who are clearly now, at least a lot more clearly today than we were last week, clearly in a strategically sensitive industry or asset like AI, for example. Is this clarity? Can we view this ruling as a positive thing, that it's now clear where that line is?
I think yes and no, because the ban certainly resets this offshore playbook that frontier AI companies now have to work with. And for years, the strategy was for Chinese origin tech firms to globalize through structure, to move the headquarters, to raise foreign capital. But Manus shows that this is no longer enough because regulators will scrutinize not just where the company is incorporated, but they will ask much deeper questions like where the technology is being developed, where the engineers came from, and where the data infrastructures were built, and who ultimately is control of the roadmap. So I think this changes the risk equation for many of these AI companies seeking to go offshore or pursuing some of these merger acquisitions, as you alluded in the question.
Okay, so it might limit the M&A, sort of the exits, the broader exit strategy, Stefanie, a lot of these AI. But I can't help but think about the TikTok story in the U.S. where, the transfer of the algorithm was really at the core of the issue, at least based on what the headline suggested. I mean, just using that as a jumping off point then, does this limit the commercial viability of overseas markets for Chinese tech startups, for example? Can we treat those two things as separate, where the algorithm, where the model is, and where the market is, which could be outside?
Yeah, that's a good question. I think the real policy implication that arises from this case is that Beijing is really prepared to securitize offshore AI firms, even if they're compliant from a commercial standpoint. So the Manus case adds a front to the U.S.-China AI contest in the context of the U.S.-China rivalry, because this is not just a competition over who builds the best model, but it is really a contest over who controls the know-how, the data, and that matters. I think because China is also saying that in response to Washington can also screen strategic technology deals through its own. The U.S. has its own Committee on Foreign Investment in the United States to address national security risks. Europe and Japan, They also have their economic security tools. So why can't we do the same? So essentially, it's saying that China is really not doing anything different. But I think where it's really different in this case is in terms of its reach and its discretion, because Manus had already moved offshore and presented itself as clearly Singapore-based in 2025. So the very clear signal, I think, at the end for the market is that Beijing is going to be prepared to securitize offshore AI firms, even if they're legally compliant, which is what Meta had said from a commercial standpoint.
Right. Stefanie, thank you so much for the time. Let's continue this next time, please. Stefanie Kamder, Assistant Professor of the China Program at the Institute of Defense and Strategic Studies at the Nanyang Tech University. Okay, lots more ahead. Markets are doing this. This is Bloomberg. We're doing actually quite well, as you can see on a benchmark basis. I think reversing really the weakness that we had on Tuesday, where really when you look at the rest of the Asia Pacific on Tuesday actually went the opposite way. So we're just basically flipping the coin the other side of the day here. Just to mention, Timor is out with its latest call on easing out of mainland China, and they're now basically pushing that back on the timeline you see bottom of your screens. Lots more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the Hang Seng Index a half hour into the session. Of course, we have been seeing the Hang Seng Tech rallying quite hard, following on from yesterday's underperformance. Now, today, it is against the backdrop of that rotation that we saw overnight in the U.S. And today, Hua Hong, SMIC, those AI hardware names are the ones that are dragging the Hang Seng Tech. Going the other direction are the AI takers, so to speak. So you have Kuaishou, Alibaba. Those are the stocks in the green. And of course, helped along by what we're seeing in BYD as well. That stock climbing today following the earnings. Dave?
Yeah, it's a good day today. We just have to string together successive wins. Because the 26,000 level on the Hang Seng is one that's been awfully common recently. It's really been hugging that level, I think, a lot more than koalas hug themselves and each other. That's for a different day. S&P futures are managing to shrug off some of the OpenAI concerns overnight, so we're slightly higher on that. Taiwan, of course, is perhaps falling in tandem with the Nikkei, of course, which is close today, so the futures down as far as that's concerned. Happened this morning. Taiwan is now bigger than Canada after surpassing, I think, the UK a few weeks back. Korea, by the way, also surpassed the UK very, very recently, and I think next in line will be Taiwan in a couple of weeks. Well, first, Korea might then surpass Canada, and then I think it's Taiwan. Next in line is India. There we go. And if it does surpass India, it becomes a top 5 market globally in terms of market cap. FX markets, I think the continued pain we're seeing in the oil markets, this continued climb is really hitting EM and EM net importers of energy. The Philippine peso is continuing to see weakness, as with the Thai baht. Record low close on the peso yesterday, continuing to see more weakness there. The oil story looking like this. The Journal reporting this morning that the U.S. president is telling his staff and his aides to prepare for a prolonged blockade. Dollar is weaker, but oil is continuing its slow march to the upside, 111 now on the most active contract on Brent. Avril.
Yeah, and as we continue to track developments, perhaps ramifications from the Iran war, of course, it's also been about how the UAE is saying that the impact of the war was a key factor in its decision to leave OPEC. The Emirati energy minister told Bloomberg's Jumana Basechi the move will give his country the agility it needs at an unprecedented time in energy markets.
The decision is taken at the right time in our view, because it's not going to hugely impact the market. The market is under supplied, and because of the unfortunate closure of the Strait of Hormuz and the level of inventories that we have.
Jumana joins us now from Dubai. Jumana, you spoke to the minister. I mean, tell us more about the decision by the UAE to leave OPEC.
Yeah, absolutely, Avril. And what a decision it was. The rumor mill was going into overdrive for all of yesterday that a big announcement was coming from the UAE. And of course, it did come in the afternoon over here. The UAE announcing that they are leaving OPEC officially as of May the 1st. Now, I had the opportunity to speak with the UAE Energy Minister, Mr. Suhail Mazroui, shortly after the decision came out. And you heard a little bit there about the justification for that move. And of course, the first question I asked him is, why is the UAE making this decision now? And he cited the favorable market conditions. He said it was a careful decision that was taken. And the key here is we are in a situation, as we've been reporting for several weeks now, where the oil market is very much undersupplied. We're talking about 10 to 12 million barrels a day that are not reaching their final customers. So this was an opportune time for the UAE to make this decision without causing a huge stir to the market or huge shockwaves, because at the end of the day, the strait is still effectively shut. Now, the backdrop to this, obviously, is that the UAE is one of the most influential members of OPEC. They're not the largest member, that's Saudi Arabia, but they are one of the members that carry a lot of political clout and a lot of spare capacity. And in recent years, there has been growing friction between the UAE and Saudi Arabia about the UAE's production capacity. They've been wanting to produce more. They've been building up their capacity. Right now, or before the war, they were producing around 3.6 million barrels a day. The target is to get to 5 million barrels a day by 2027. But of course, they feel like they were restrained by the production quotas that were coming through from OPEC. So this move liberates them from being coordinated with the rest of the group, of course, once things normalize. Now, I did also ask the energy minister whether there was a political dynamic to this as well. And, also what we've been reporting the last couple of weeks is there's been a difference in approach in terms of how Saudi Arabia have been approaching the war with Iran versus UAE, and whether the timing for this actually optically looks good, given that the GCC should, in theory, have a collective stance versus the aggressions that have been taking place from Iran. Here's what he had to say.
It has no political linkage. Our relationship with all of the producers will remain there. They are neighbors, they are partners in many shapes and forms. And as an active and a proactive producer, UAE will always be there. We're not disappearing from the market. We are a responsible producer. We just want to have the freedom to take the decisions that is required due to the situations that we are living in.
So playing down the political dynamics there, and essentially saying that we just want to have the freedom to make our own decisions. Certainly a big blow to OPEC. As of yet, not a big dent to the market, but we have to see what happens once things actually return back to normal and flows start going through the strait again, how much the UAE will increase production, and will it incentivize OPEC themselves to also increase production?
Yeah, there's very little indication that we are moving towards normalcy. And I want to get your take on this journal report in a moment. But just very quickly on that, clearly the war did not help. So what impact did the war have on this decision? And what happens now to the group?
Yeah, it's a good question, David, because ultimately the catalyst wasn't the war. I think the excuse, the pretext was the war, in the sense that it had taken all of these oil barrels off the market, and the UAE identified a window of opportunity to leave OPEC without causing a huge dent or rupture to global oil markets. Now, if they had done this a couple of months ago, I think the market would have been very quick to assume that we were going to be unleashing production supply. And there are precedents to this. Obviously, you have to go back to 2021 when there was a dispute between the UAE and Saudi Arabia about their respective policies. And in general, what you can say is the Kingdom of Saudi Arabia has been looking to put a floor on oil prices. They want to keep oil prices relatively high. They have these massive spending programs that they need to fund. The UAE's economics come from a different perspective. It's a lot more of a diversified economy. For their perspective, they've been wanting to produce as much as possible. And so the Iran war presented an opportunity insofar as these oil supplies are constrained. But again, what people are saying is later down the track, you just have to watch the space and see how much extra production could be hitting the market, and also whether it changes the Kingdom of Saudi Arabia's approach as well to keep these prices elevated. Possibly what we're in for, though, down the track is more volatility.
Yeah, well, the strait remains largely shut, I guess, apart from massive super yachts, and I'm sure some people have seen that story. But on this report out of the journal today, that the U.S. is preparing for a prolonged closure of this. What do we know about that?
Yeah, so this story hit the wires about an hour ago. It's moving markets here. And I think we've been waiting for President Trump and the White House's response to the Iran proposal. Remember, we've been reporting about that the last couple of days, whereby they had bifurcated the issue of the strait from the issue of the nuclear file. Now, no formal response has yet come through from the U.S., but the Wall Street Journal are reporting that Trump considered all of the options, and out of all of the options, he thinks keeping the naval blockade is the most effective way to go by it. The other options would include a return to hostilities, and of course we've had a ceasefire in place since April the 7th. The other option would be just to simply walk away. But from the U.S.'s perspective, and President Trump, Marco Rubio has spoken about this in the last couple of days, they seem to think that the blockade is working. And in fact, yesterday we were reporting, looking at Kepler data, that Iran's storage capacity is going to fill up in the next 12 to 22 days. That is going to put a lot of pressure on the Iranian economy. President Trump's thinking, per the Wall Street Journal, is the longer the U.S. naval blockade goes on for, the more incentivized Iran will be to come back to the negotiating table, because for him, it is a non-starter to separate the matter of the strait from the nuclear file. It is an unacceptable outcome and something that he can't present back to his base, that after 2 months of war, the only achievement has been to reopen the straits and not get an outcome that they're looking for on the nuclear file, which is that Iran commits to never developing a nuclear bomb. So this is the Wall Street Journal reporting. No official response yet from the White House, but we will wait and see if they comment on anything officially in the next 24 hours.
Jumana, thank you. Jumana Bersetchi, anchor there of Horizons Middle East and Africa. Right. Now, amidst all of that, of course, lots of people were expecting maybe does China actually lead the rebound here. That actually hasn't happened, right? When you look at, when markets bottomed about a month ago, Chinese benchmarks, I think most Chinese benchmarks, because the Chinex has done something else, we get to that later, have actually underperformed. And the question really is why? Bank of America says investors have been asking that very question, and that a better position because of China energy self-reliance, the Iran war. It should be noted that the underperformance does not include, it's scripted. Okay, I'm just reading my script here. The NASDAQ-style Chinex index. There we go. Very nice. Okay, let's bring in Winnie Wu. She's been waiting here, head of APAC equity strategy at BofA Global Research. I mean, why is a good question. It's one economy that isn't pressured to raise interest rates. It's energy self-sufficient. Yet the market has not responded intuitively.
Yeah. That's certainly been a huge debate among, China market followers. I think, there's probably a few reasons. The first thing is that market seems to be saying that AI is the only story in town. Right, energy prices, the ups and downs, it either temporary or it doesn't really matter, because for the big tech companies, they can pass it through, so it doesn't impact the earnings. Right, and secondly is also recently we are also going through the earnings season, and if you look at the rest of emerging market, TSMC's, Hynix, they are reporting consensus beating earnings, and earnings forecast for MSCI EM has been revised up. From beginning of the year, consensus was forecasting 29% growth. Now they're looking at like 45%. For MSCI US, the earning expectation was also revised up. Whereas in China, earning expectation was actually reduced, right? Beginning of the year, consensus was forecasting 11 to 12% growth for MSCI China this year. By now, we're looking at 5%. Yeah, and that's mainly because the internet sector is still facing the challenges from both a cyclically soft economy and also the structural challenges of potential AI disruption, right? And the third part is, we saw that in both US and China, semi sector is showing good result, strong share price outperformance, whereas software and software adjacent internet sectors being derated. Last time when we talked about the real mode report, we talked about this. That actually happened in China as well. But the difference is semi now is around 16% of the US market indices, right? Up from only 6% 3 years ago. But in MSCI China, it's still only 2% of the index. So the index composition difference also amplify the performance difference. So, to put it together, for China market underperformance, one is because market are not focusing on energy prices, but really prioritizing the AI story. Two is for China, earnings has still been dragged down by its major internet sectors, the still relatively soft consumption, property market, and three is index composition-wise. MSCI China in particular, HSCI are too dominant by internet, whereas some of the Asia indices, Chinnex, CSI 500, even Star 50 has done relatively well because they have more composition of sort of called new economy, tech, semi-related stocks.
Winnie, to your point then, does that mean that there's more to go when it comes to the AI play for China, especially given, as you mentioned, the index composition? Maybe there's more to unlock here. And then as well, when it comes to how, China is promoting AI adoption. Think about how OpenClaw has fared, right? But maybe we're not still seeing the growth, the earnings impact. There's more to come on that front.
Yeah, I think, from a medium-term, longer-term perspective, absolutely, right? We are seeing more IPOs of some of these new economy companies, right? In the past 6 months, we got more LLMs coming to the market, more of the chip companies, potentially we'll see some of the memory companies coming to the market. So as the IPOs of the new economy companies come in and as their earnings growing, share price outperforming, the index will naturally rebalance to incorporate more of these, real new economy sectors, which will help the index performance. But also, I think is that, to your point about AI adoption application, you're right that interestingly, despite the OpenClaw frenzy like 2 months ago, we haven't seen AI adoption leading to very significant impact on China's jobs or earnings or GDP growth. And I think it's reflecting a few things. One is in China, there are still abundant supply of inexpensive knowledge workers. Right? Two is Chinese regulators, government are concerned about the job market. So, whether it's government or SOEs, you can't just install agentic AI and fire 1,000 people. You can't do that. Right, and that also kind of limit companies' willingness or motivation in terms of aggressively invest and deploy AI. Right, Chinese companies have been more cautious in terms of risk control and the AI deployment. And finally, I think it's also there is a real constraint in terms of China's compute, memory, storage, and model capability. So with the exponential growth in demand for agentic AI, it does strain on the capacity side. So the real effectiveness, the impact, the efficacy of these OpenClaw hasn't been as strong as people initially anticipated. Yeah, but these things will gradually come together.
Winnie, stick around. We have more to ask you after the break. Winnie Wu from BofA Global Research is staying with us. But coming up as well, BYD's near-term debt soaring to record highs. As it tries to get through an earnings slump, we'll ask HSBC Global Research what this means for the company and the Chinese EV market. This is Bloomberg.
We're back here with Winnie Wu, head of APAC Equity Strategy at BofA Global Research. We were just talking during the break, an emerging theme that you mentioned we should be paying attention to is the strong currency, renminbi, has started to show up in these earnings results.
Yeah. So, generally speaking, RMB going up should be a good sign, right, for the RMB denominated asset. But on the other side, export has been the most important driver for China's economy in the past couple of years. And RMB appreciation will add to some pressure in terms of China's exporters' earnings. And in the latest earnings season, we see a number of companies, export growth volume was strong, but RMB, the FX loss, right, lead to the bigger than expected decline in FX loss, which lead to earnings disappointment. Yeah. Also, the other thing is, with the higher energy prices, with RMB appreciation, what does it do to the ASEAN economy? Because by last year, ASEAN has become the largest export destination for China. It's now 18% of China's export, right? Of course, some of this may be transshipment, but still, ASEAN is the biggest market. And now ASEAN market is already facing the challenges from higher energy prices. And if RMB is also appreciating against these currencies, does it hurt China's export to these markets? And what does it mean for China this year's GDP growth? So I think, while we're celebrating RMB appreciation, which is quite good for some yield sector like Chinese banks, right? Domestic-driven yield is 5%, plus 5% RMB appreciation, 10% return, perfect. But for some of the other real economy companies, especially exporters, this RMB appreciation could be a challenge this year.
And just the overview there is, for investors in terms of sector picks, is it still leaning in terms of dividends and where that is predictable? And how do you feel about, say, a sector like autos where competition is still, it's really showing up quite badly in these financials? And how do you feel about sectors where you have intense competition?
So in this yesterday's report, we did look at how the sector, MSCI China sector performed against their earning revision. Yeah. Generally speaking, for H-share ADR market, earning revision is the very important driver. So, banks, materials, industrials, generally earning revisions are stronger and the share price are indeed outperforming. But for A-share on the other side, A-share earnings actually doesn't matter as much, right? If you look at CSI's 1,000 star 50, year to date, earnings being revised down, cut 15 to 20%. Nonetheless, they still outperform HSCI. They still outperform the Shanghai comp because Asia investors probably focus more on the long-term thematic plays in these new economies. And they also have a preference for mid-small cap stocks, which are perceived to be less impacted from all the macro geopolitical risks. So from our perspective, for the overall MSCI market, we do prefer the companies with more defensive and the steady earnings growth. So for second quarter portfolio, we've highlighted banks, energy, coal, material sectors, some of the industrial sectors in our top 10 portfolio.
Just very quickly on AI and concentration, that could, who knows, that could go up further, 2,000%. But how do you look at concentration risk? Are people just closing their eyes when they look at this momentum trade? I can't afford to step out of this, but in some ways I feel kind of nervous about what's happening.
Yeah, totally. This is a huge debate, right? On one side, and then this is not the first time market worry about concentration risk. In fact, 6 months ago, right, October, November, people were worried about concentration in the U.S. semi stocks, like in NVIDIA. Now people's worry is the concentration in memory stocks, right? Everyone owns them. Is that structural or is that cyclical? When people shift from PB valuation historically on these memory stocks to PE, is that sign of market peaking? The debates are certainly there, but I think realistically, the consensus view is that even if it's a concentrated trade, I don't want to be the only one that's missing out, right? So you just have to play along. And also, as long as earning momentum remains to be very strong, and in fact, for now, earnings still being revised up, people are willing to, continue to play, dance to the music.
Yeah, there we go. Even if it's 3, 4 a.m. and the cops are maybe circling around, not that they are. Of course, Winnie, fantastic. Thank you so much. Winnie Wu there, head of APAC equity strategy at BofA Global Research. On that note, right, Samsung's coming out with earnings tomorrow. Lots more ahead. This is Bloomberg. right. Who remembers the old school Nintendo that game? I think it was it Battle City? Anyway, we're talking tanks. This main battle tank. So Hyundai Rotem is able to announce his contract with a Polish defense contractor, and that contract, winning that contract, is lifting the overall tide in defense. Very quickly, NIO is also out, speaking of transport here, this new family SUV segment. Lots more ahead. This is Bloomberg. Okay, welcome back. You're watching the China Show. So it's about the time of the day when we should be looking at Japan. Japan cash markets are shut today, so that's your public service reminder of the day. Okay, so has BYD actually hit the trough? And as far as the corporate story is concerned, I mean, the markets are reacting quite positively to the numbers where you had, I think, a drop in net income. You had the big FX hit, of course, which is part and parcel to why the net income dropped. I think you look underneath the hood, no pun intended. Things like inventory levels have picked up, bills payables have picked up, short-term borrowing has picked up. So I think it's indicative, really, when you look at cash flow and what they're doing to manage the cash. It's a conservative situation, and they're increasing short-term borrowing. You had this decrease massively in operating cash flow. Net changes in cash was positive, but free cash flow overall remains negative. So how do we need to be looking at this earnings reports through the prism of the future? Joining us here in set is Ding-Yu Chen, head of China Auto Research at HSBC Global Research. Very nice to see you. There's lots to talk about. We had this big car show, of course, in Beijing. But why don't we start with BYD? If I am sitting on a ton of that stock, should I be worried about this earnings report?
I would say last night's result is a solid in line.
Okay.
And also probably a sentiment beat given the recent rising short interest. I would highlight the gross profit margin is really a key highlight. First quarter is the trough. We already know that. We all know that. It's low seasonality coupled with subsidy transition as well as BYD's own model changeover. So everyone knows that. But actually, given the quarter-on-quarter economic scale, almost half the BYD margin actually is first quarter margin is higher than fourth quarter because of the mix. The overseas mix has been a strong support to the margin side, and since BYD has been launching the new technology, the second generation battery, flash charging, they've also been refreshing and launching new models. So we just got the data last night. BYD Song Ultra in the first month order book is more than 60,000, and also last Friday in the auto show they've launched the high-end model Grade 10 that has been booking 30,000 orders in the first 24 hours. So the coming new model ramp up and also continuous model cycle would support the quote-unquote improvement in the coming quarters.
Okay, and what do you think would be the best financial indicator to watch as far as BYD is concerned to effectively support that narrative that the Q1 was in fact the bottom?
I would say the model ramp up for sure.
Okay.
And also, since BYD is shifting their battery capacity from Gen 1 to Gen 2 blade battery, so that probably lost some production pace over there. So how fast that they can ramp up to support the new model launches and eventually overseas market starting from next year would also be the key. So in short, I would say new model and the monthly volume cadence.
Let's talk about, we were joking, I was going to say, let's talk about the auto show, but it's really a tech show with just a side offering of autos. What impressed you the most from what they just displayed recently?
Yeah, first of all, almost a larger portion of the hall is a gloating blue light. So, which means autonomous driving mode is on. Okay. So I think autonomous driving, of course, is one of the key focus. And also, we also notice that there's robots serving your coffees walking around the halls. And we see more AI agent functions has been building into the cars. And also, we see the robots has been standing by side the cars like they are future colleagues. So I would say the AI involvement, the autonomous driving involvement, and also the robotics involvement would be something within the industry that has been keyword watch.
What does that have to do with the P&L of the car companies?
Yeah, so great question. So we need a profitable business to support the future innovation.
Okay.
So of course the P&L, the profitability is very important. So I think the product mix, the overseas expansion do helps to support on the margin side, so that the companies would have sufficient cash and the capex as well as the R&D budget to investing in AI applications as well as the next generation robotics.
You guys put out this report a few weeks back, future transport. Talk to us about that. What future trends do you think we should be paying attention to here, beyond just a quarter-and-quarter obsession over earnings and what have you?
Yeah, so if we want to highlight a bit of the structure side of the debate, we would say the autonomous driving narrative has been quickly shifting from last year's technology differentiation towards this year's commercial scaling. Okay. Technology is maturing. The regulatory framework has been supportive. The public obviously is very interested in terms of adoption. So not much real roadblock here. So the capabilities of the company with the capability, how fast they can scale in an economic way would be the key focus of the market this year.
And from a sector perspective, are there any bottlenecks between the current point and getting to all the autonomous driving realization?
Of course, it's going to be a phased rollout. First is the ODD area, restricted area within certain districts, for example, Nanshan. But recently, Guangzhou, the whole city has been opened up. Okay. So with more city join the club, with more areas remove the restriction, we do see that's a huge support to the commercialization. And of course, on the industry key player side, it's very important in the early stage. They collab with the car hailing company, and also they have enough capital to deploy at scale if they wanted to.
Do any OEMs stand out to you as being better positioned than their peers in as far as this trend is concerned?
Yeah, speaking of the robotaxi, we do want to highlight XPeng as OEM because they will also launch 3 robotaxi models this year along with their new model cycles, and they're also running pilot project in Guangzhou. I think we'll probably see this company will also be able to join the robotaxi race soon.
Right, and when do we expect them to show up on, let's take XPeng as an example, to show up in XPeng's P&Ls?
I would say in a marginal way by the end of this year. And I think that should be materially kicking next year. But also, I think there's a bit of a business model difference. While we are talking about autonomous driving, it takes different format as a technology operator or you are a smart EV manufacturer. So in terms of the XPeng, its current business is a smart EV manufacturer. So in terms of expanding into the robotaxi, they could be the technology provider. Their partnership could become the operator. So that would be also the business model evolving as the whole industry theme unfold in between different players.
The two other two other themes that are continuing to, I think, show up in the sector is, I want to get your thoughts on this energy transition because of what's happening in the Middle East. But just initially, price competition. Where are we in that phase? Do you see the light at the end of that tunnel?
I would say we're still, unfortunately, I know we've been discussing this for quite a long time.
I think every time you're here, we ask the question.
Yeah, exactly. So I would say we're still pretty much still in the process of consolidation, which means the pricing pressure is part of life. But again, I would say the overall pricing condition has been largely eased since last year's anti-involution initiatives. And we see our companies has been actively moving up the pricing curve and use technology leadership to buffer the pricing pressure. Taking BYD, for example, their flash charging, their next generation of battery do give them the technology edge in the domestic market as well as the global market as along with their capacity rolling out. And also the higher pricing point would the better mix will also help to support on the pricing side as well as margin. So we just talked about the Song Ultra and grade 10 model. They are above the pricing point of 150,000 RMB. That's above like BYD group average. So they have been making solid success in the higher pricing point model lineup. So which help them to buffer the pricing pressure or in general.
And is it clear to you that consumers are responding quite clearly to the ability of OEMs to offer specific tech? In other words, are they willing to pay the price because of a unique tech offering?
Yeah, great question. So that's why the Song Ultra's order book out last night, and also the first 24 order book of Grade 10 has been a good validation that consumers are buying, because BYD has been loading the most cutting-edge technology in these new models, and also they're rolling out the flash charging infrastructure nationwide, which provide further support for the lifetime usage of this model. So you see the positive spiral starting from here, and also we notice in the Grade 10 they have been trickled down their top-notch technology, such as the intelligence chassis system, from their high-end dental models into their mass market portfolio, although priced higher. So I think these technology maximization does help these products to increase their attractiveness among consumers. And the recent order book momentum shows consumers are willing to pay.
And I mean, it just makes me think every time, I would say every time, but it's more often than not when a car company comes out with a new model, the order book fills up quite quickly. How short is the replacement cycle in China? How often do consumers replace or upgrade their vehicles? Do we have any insights on that?
Well, you're onto the very core point of the industry core competitiveness. Yeah. I would say in China, the speed of iteration, the speed of product cycle is faster than the rest of the globe. And the consumer also respond faster to that. Okay. So first of all, from the corporate side, if you refresh faster, if you're loading the most of the cutting edge technology consumer do buy, you do see the positive market influence. And from the replacement cycle perspective, usually in China it averages 3 to 5 years. So since the technology has been evolving faster, most of the consumer know the minute I buy the car, it's started to depreciate. But I guess this is like a constant dynamics, right? But if you buy, you get access to the latest technology. So I think consumer gradually getting used to that. You don't want to own your smartphone forever, right? You will upgrade every couple of years.
They force me to upgrade, but yes.
You catch the drift. That's a similar dynamic we're talking about in today's smart EV industry.
It's crazy to think that a car today is completely different from the tech a car 3 years ago. And 3 years from now, we don't even know what a car looks like. Can I ask you about the overseas markets? This reminder from this energy shock we're seeing in the Middle East, do you think that will accelerate the adoption outside of China in terms of EVs?
Yes, we've already seen the momentums coming. So let's say,
in what way?
Yeah, in what way? Since the oil price hike, BYD's Australian sales tripled.
Okay.
So I think that's a positive sign that the oil price and also the supply shock basically are structurally making consumer to consider EV in a more active way. So I think that does support structurally in terms of mid to long run the global EV penetration. So I think the whole oil tail has been a structured tailwind for the EV as well as the batteries, because of the adoption curve got support. It's not overnight. It's a structured consumer decision. Okay. And although the price of the oil probably normalized at some point, but again, the consumer conversion has already happened and is started to accelerate with the latest data point. And most of OEM we talked to basically expressed a strong conviction in terms of meeting their overseas target or beating them.
Fantastic. I'm always amazed, by the way, just as a note, how you have all of this information in your head. 0 notes, if you could take a wide shot here. All that information in the head of Ding Yu Chen there. Fantastic. Head of China Auto Research at HSBC Global Research. Right. Speaking of the earnings story in China, lots more coming through here. Let's have a look at Longi Green. Yeah, there we go. Down about 4%. Today, first quarter net loss widened to $281 million. The results came in despite this rise in solar module prices, reflecting the elevated cost of silver. Now, the company says in a filing here that weak product prices, low utilization rates, and rising raw material costs have weighed on the company's operations. Right, Ping An Insurance also out. Shares should be up. What are we doing now? 5%. Very nice. Robust first quarter results thanks to strong new business value growth. And that comes, of course, despite first quarter profit falling about 7.5%, 7.4% to be more exact here, as the stock market slump slightly hurts investment returns. The benchmark CSI 300 stood almost 4% during that reported quarter, of course, weighing on the value of the insurer's stock portfolios. We have lots more ahead here on shows. This is Bloomberg. Right, welcome back. It's just gone past, 10:40 in the morning here in Hong Kong. So just in case you're joining us on the East Coast and looking at how markets are probably going to open up your Wednesday, it's looking good, actually. So tech led the declines, and tech is leading the bounce in the early goings of today. Let's have a look at, of course, the culprit, if we could point our finger at one. OpenAI is pushing back against this report, saying it missed several internal revenue targets. Now, the ChatGPT creator calls this Wall Street Journal story prime clickbait and says it continues to see growth in its consumer and enterprise businesses. Now, the journal says CFO has expressed concern that OpenAI may not be able to afford its future computing needs if sales don't grow fast enough. Okay. Let's have a look at Amazon, AWS, Amazon Web Services here says, the company says it will finally be able to offer, speaking of OpenAI, its models to its customers. That's after the ChatGPT maker ended its exclusivity agreement here with Amazon's largest cloud rival, Microsoft. Speaking exclusively to Bloomberg, AWS CEO Matt Garman told us about what their expanded partnership might mean.
Well, we're quite excited about the partnership that we're announcing with them today. For a long time, when we built Amazon Bedrock as a way for our customers to access frontier models and access AI models, we've always started with the position that we wanted to offer choice, and we wanted to offer all of the best models available out there. And today we're excited to be bringing OpenAI into Bedrock. I think it's something that our customers have asked for a really long time.
And we're talking specifically about frontier models, not just open-weighted models, which was
that's right. We've had open-weight models for a while, but yes, this is the frontier model. So starting in preview today, we have OpenAI's Model 5.4 and 5.5 is coming in the next couple of weeks. We're also collaborating on a new offering which we called Managed Agents featuring OpenAI, which is a complete managed agent capability so customers can really easily make stateful agents and build agentic applications together with Bedrock and OpenAI. And it's really just the start of a long-term partnership that we've established together. As the teams have gotten together, we see opportunity for us to really invent new capabilities for our customers to go and build interesting applications together. And really excited about working together with the OpenAI team and unlocking more things that customers can build on AWS.
We are in a strange situation where OpenAI models can now run on AWS, but Microsoft will benefit financially because of the latest terms of their agreement. They've ended exclusivity, but OpenAI continues to make payments to Microsoft.
Yeah.
How do you think about that?
Oh, that's okay. Look, Microsoft has benefited from the growth of AWS since the very early days, in fact. We've supported Windows licenses, as an example, right. I think since 2007, 2008. I can't remember the exact year. But so Microsoft has benefited. They build great software. They have good partnerships, and they should benefit from those. But customers really want to use those technologies. SQL Server is a good example that runs great on AWS. In fact, many of our customers tell us that SQL Server runs way better on AWS than it does on Azure. And so for those customers, running in AWS is where they get the best reliability, the most security, and the broadest set of features. And so that's great. And if Microsoft benefits because their software or their partnerships or their licenses are being used inside of AWS, that's great. And in this case, we partner with Microsoft, just like we partner with Oracle and other providers that build software. And we want to make all capabilities available on AWS for people to build.
There you go. That was Ed Ludlow, our co-anchor, of course, at Bloomberg Tech, exclusively with the CEO of AWS. Right. If you want to catch more of that interview or others that you might have missed here on shows, you can check it out for our clients. the Bloomberg Video Hub, the new Bloomberg Video Hub. So everything, TV shows, interviews, documentaries, report analysis. So check it out. Bloomberg.com/videos. This is Bloomberg. Right. As you see on your screens, West Texas is back below 100. Some declines we're seeing in the Brent markets. And I think there was this journal report, which is interesting, and I think something to watch in the next few hours or so. The U.S. president has basically told his aides here to prepare for an extended blockade. It's something to keep an eye on, of course, because you have, of course, the Energy Secretary, Chris Wright, has really downplayed Iran's ability to handle a production shutdown if, in fact, that blockade continues to choke off exports. Now, he told Bloomberg that Iran's old stockpiles mean that storage capacity is actually limited.
Well, look, there's monitoring of storage tanks at Karg Island and around the nation of Iran. But, yeah, they don't have a huge amount of storage capacity, and they've got old reservoirs that are low pressure, which means it's much more destructive if they have to shut in their production.
Kepler, Mr. Secretary, is talking about 12 to 22 days left that Iran has in terms of storage before they have to shut in. Do you see the president making any sort of decision on Iran's proposal before that time period is up?
The president's focused on getting the right deal. That could be independent of their storage, but obviously that puts great heat on Iran. If we can get the right resolution, that could be tomorrow, that could be 2 weeks from now. But the key thing is the right resolution. Iran, and let me just put the context again, Iran has roughly 1,000 pounds of 60% enriched uranium. There's no commercial, peaceful use for that. That's bomb material, and that's 10 days, 2 weeks tops to turn that into highly enriched uranium for bombs. So this is an existential crisis. I'm very proud of the president to stand up and put an end to Iran's efforts to get a nuclear bomb.
Well, so it doesn't sound like the president would take this off-ramp from Iran, which is reopening the Strait of Hormuz. Obviously, the U.S. blockade would have to end, and then kicking the can down the road when it comes to talks on nuclear.
Yes, again, the critical outcome here is that we end the ability for Iran to have a nuclear weapon. There's many ways that deal can be structured, but the compromise will not be made on the principle no nuclear-armed Iran.
We see gasoline prices on average rising again this morning. They're above $4 a gallon. You recently said the administration plans to do more to bring down U.S. gas prices. We saw the waiver on the Jones Act extended. What else are you thinking about?
When you also saw announcements on the EPA for blending requirements this summer that allows our refineries to produce a lot more gasoline. Unfortunately, a few states foolishly did not go along with it. So California is still going to have outrageously high gas prices. New York State, I don't know why, also did not go along with the federal regulations. But we're doing everything we can to increase refinery throughput. American oil production is at record high. American oil exports to our allies abroad are at record high. So look, we're going through a period of discomfort to solve a 47-year crisis.
That was Anne-Marie Hordern there, of course, with the U.S. Energy Secretary Chris Wright, on many fairly globally consequential topics there. And we're feeling it, right, this part of the world. To my left, the Philippine peso, 5-day low. We are, in fact, on track at 2 days, yesterday and today, on track for the worst 2 days since the start of the war, since the beginning of March. So with this conversation we had with the central bank governor very recently, it's not the level, it's the delta, it's the extent of the change. And might this actually be prompting, could be currently, who knows, the central bank to be present in these markets. Have a look at Hang Seng Tech gainers here to the upside. A lot of big names to track there going into the last hour of the morning session here in Hong Kong. And just a reminder, it's a very big earnings day, so some names are coming through. The big banks are coming through out of China, plus a whole gamut of others across industry. We have lots more ahead on Bloomberg Television. We'll see you all tomorrow here from the China Show.